Alright, let's cut to the chase. Google just dropped its Q2 earnings, and while the numbers look strong, Wall Street isn't exactly throwing a party. Why? Well, despite beating expectations on both earnings and revenue, Alphabet's stock dipped over 2% after the bell. That's right. Even with killer performance in ads and cloud, investors hit the brakes. So what gives? The tech giant revealed it's jacking up capital expenditures to a jaw-dropping $85 billion, up from a previous projection of $75 billion. That extra $10 billion is mostly headed toward AI and infrastructure, but it's spooking some analysts who think it may pressure margins in the short term. So now, the question is, are we witnessing a long-term bet that pays off big or a costly overreach? Let's break down what really happened this quarter. Alphabet reported adjusted earnings per share of $2.31, easily topping Wall Street's expectation of $2.17. Revenue, excluding traffic acquisition costs, TAC, came in at $81.2 billion, beating the $79.6 billion forecast. For comparison, last year's Q2 number was $71.3 billion. So yes, this is solid growth. Much of that lift came from Google's bread and butter, advertising. Search ad revenue soared to $54.1 billion. Beating expectations of $52.7 billion. YouTube ad revenue also crushed it, hitting $9.8 billion versus the $9.5 billion estimate. These numbers show that even in a shifting digital landscape, Google's core ad model still has serious muscle. And CEO Sundar Pichai made sure to emphasize AI as the new engine behind that growth, pointing to features like AI overviews and AI mode in search. But it wasn't just search and YouTube flexing this quarter. Google Cloud is quietly becoming a bigger piece of the puzzle. The cloud division saw solid gains in revenue and profitability, now boasting an annual run rate over $50 billion. Pichai called it out as a key growth area, especially as enterprise demand for AI tools and large-scale infrastructure skyrockets. It's also worth noting that Google's focus on subscriptions is starting to pay off. Though exact figures weren't highlighted in the earnings call, the company did mention continued momentum in those areas. So while search is still the king, Alphabet is clearly working to diversify its revenue streams. That diversification could be crucial, especially considering the growing legal heat coming its way. That brings us to the elephant in the room, Google's ongoing antitrust battle with the U.S. Department of Justice. A federal judge has already ruled that Google violated antitrust law by squeezing out rivals in online search and search ads. The next phase? Remedies, and they could be massive. We're talking about the potential end of exclusivity deals with companies like Apple, which currently make Google the default search engine on millions of iPhones. Even more extreme, the judge could force Google to sell off its Chrome browser. That would be a seismic shift, cutting into Google's search dominance and, by extension, its ad revenue. No timeline is locked in yet, but a ruling could come as soon as next month. If you're Alphabet, that's not just a legal risk. It's an existential threat. So here's where we stand. Alphabet is firing on all cylinders when it comes to revenue and AI-driven growth. But with sky-high capex and looming antitrust rulings, the road ahead is anything but smooth. The company is clearly betting big on AI, not just in products, but in infrastructure, chips, and cloud. Whether that $85 billion spend pays off or backfires is the million-dollar question. For now, Google remains one of the most powerful players in tech. But even giants can stumble if the pressure from regulators and investors piles up too high. We'll be watching closely over the next few quarters to see how this all plays out. Make sure you hit that like button and subscribe, because this story is just getting started.